First rates Monday morning, we start a brand new week and with an assumption that we are likely to extend itself on at least in terms of the market mood. The market mood is that the Santa rally hangover is over. But in small and mid-cap stocks, the party continues. I'll address the newsmakers first. Federal Bank. Let's address what do we have in terms of Ather, Titan, Godrej Consumer, Marico. Just the newsmakers first, and then we'll get into specific stocks. Some newsmakers in terms of stocks in focus. You've got, I'll say it again, Nykaa, Marico, Ather Industries, Federal Bank. No large big changes, and markets are not reacting to news. Oil marketing companies. It was Morgan Stanley and now it's JP Morgan. All of them are of the view that oil marketing companies are going to be in for a predictable regime of earnings. And that's having an impact on HPCL, IOC and BPCL. That entire cohort of oil marketing companies has done rather well for itself. Then you want to look at, some outliers. One big outlier on Friday was Sula, and the party continues. I mean, if this one, I will not use the word hangover in case of liquor companies here, but yeah, I mean, the party continues in terms of where the price action was. So a bit of a red, the breath is okay, some reaction here and there, but in general, I think market are in a good groove, so to speak.
Right, seem to be quite okay. A bunch of other stocks which are going to be in focus, and look out for what Tata Steel does, because they've actually seen the best ever Q3 sales with the sequential growth coming in. The India business deliveries have also looked quite okay. About a 0.7% move coming in there. TVS Motors as well. They've signed an MOU with the Tamil Nadu government for an investment of 5,000 crore rupees in a span of about 5 years. So that's another stock which is in focus. There's also Godrej Consumer. They're looking to deliver mid-single-digit volume growth, see margin expansion coming in, although the stock is lower by about almost 5% after its Q3 updates. JSW Steel as well, and their one of their arms has got a possession of total of huge amount of acres of forest land to set up a steel plant. So look out for JSW Steel. ICICI Lombard, their December premiums are higher by about 20%. So these are a bunch of stocks which are in focus. And Marico, Adani, Wilmar, BOB have not been the best of Q3 updates really. Weak coming in there. In fact, even Star Health has actually missed the industry average. The December premium has come in higher by about 15% as opposed to what the rest of the players have posted. There's also Union Bank. The Q3 updates have come in higher by 10%. There's advances as well, which have seen an uptick of nearly about 11.5%. Jupiter Wagons, another 100 crore rupee order coming in from an automobile manufacturer. So loads of stocks which are in focus this morning. But Kunal, anything that's looking interesting to trade?
Well, from the mid-cap arena, of course, it's Poonawalla FinCorp, which looks attractive. But from the large-cap front, ITC is something which I think has managed to come back into a good breakout mode. The stock taking support at the 50 moving average and then bouncing off. I would believe that the stock should be able to break past about the 3-day, 4-day swing high, which is around 480-85 mark for ITC.
All right, let's take a conversation forward. Venugopal Gare joins us from Bernstein. Let's understand what is prognosis and market view 2024 is. Venugopal, good morning. Thank you for joining us. We've had a good 2023. How much of the 2023 good market, good momentum will spill over to 2024 as well? Are we in for another year of positive returns?
Thanks a lot for having me on the show. Yes, last year was exceptional, and I would just remind all the viewers as well that I think beginning of last year there was a lot of uncertainty, right? And I don't think this call for last year as well was something which was conceived at the beginning of last year. In fact, we ourselves upgraded India only the fag end of March and early April to a buy. Now the reality is that given the fact that we are sitting with a lot of gains last year, and more importantly, as I see, a lot of the base support, especially for the economy, to a large extent is behind earnings revisions, which are actually pretty good in this last 6 months of the calendar year, has also led to a situation where EPS revision momentum is more or less moderate now. So we are like more or less looking at a peaking of EPS momentum, though even though EPS growth is still very decent. So putting this into picture and the fact that a lot of the surprise positives in terms of a rate cut possibility this year, which was not thought of in the first half of last year, as well as a much better political stability outcome, which again was something which was iffy in the beginning of last year. All that is also known and sort of digested in the market, especially in the November-December rally. So I think the return expectations have to be a bit more modest this year from equities, and unless we see any further sudden surprises coming in later in the year. So that's how we're starting the year, with 8% Nifty return expectation for this year. We're essentially saying that book profits right now wherever you can, because it could be a range bound in a volatile market, especially in the sort of a near term. Not really changing a 3-year or a long term outlook, where we're still extremely bullish on India from a long term perspective.
Hi, morning. Firstly, so just wanted to understand that given there is the valuations are not cheap in the market right now, are there any bottom-up ideas available out there? And should that be the theme that one should be scouting for new ideas?
Yes, historically, to some extent, when it comes to individual stock picks, we usually have tended to avoid just taking valuation calls. Fundamentally, we've always looked at the construct of earnings growth, sustenance, momentum of earnings, the secularity of business and management. So a lot of host of factors. By the way, this year is going to be a bottom-up year to a large extent, where you have to be very careful about stock picks. So the way I would approach it is, especially a lot of these large caps look fairly okay from a growth sense as well, and perhaps may not necessarily have rallied as hard last year for a host of factors, given that you have a lot of alternate options as well. So if you look at the India portfolio that we have assembled, in fact, everything is large cap at this juncture. So I'll just mention a few because there's a published sort of a report. Financial sector to us looks fairly attractive. So HDFC and Axis are there in the portfolio. We have Infosys and IT, the only representation at this juncture because it's been an underperformer in laggard as well. Cipla in healthcare, which is an overweight sector for us. Reliance has been a pretty big laggard last year, so that's another one. We upgraded telecom to an overweight, so Bharat is another large cap. NTPC has rallied hard, but still eking out some return possibility this year because the sector looks okay. L&T is another one where, despite having run up and being rich on valuations, we're still sort of keeping it from a growth and a cycle sense. So these are the broad stocks, to a large extent. Even Adani Ports, something we added in the Adani stock for the first time in India portfolio. So these are the ones which I think from a large cap sense look fairly okay from a growth perspective.
I just wanted to touch upon one of the long-term compounding themes, and with a spotlight on digitization, given that we've seen ever so much progress taking place and so much more to come, how are you looking to really play this theme? Because it really seems to be very divided, even when it comes to the view of AI on IT, that it could be more of a bane before it actually becomes a boon for at least the traditional IT players.
That is right. See, digitization is a pretty large underlying theme. The ways to play it is going to be spread across. I've always mentioned that digitization is something which could be an existing corporate primarily, sort of digitizing. They also get benefit out of it. It could be using digital channels to sort of sell products, or it could be primarily about their own entire data architecture and the things they're trying to make themselves more efficient by digitizing internally. So host of ways of doing it. So, or you primarily play individual companies which are direct consumer tech plays, which are the sort of representations of digitization, which could be in financial sector, which could be in retail sector. So there are a host of ways to play it. Now, at this juncture, I would probably say it's very early because a lot of things are developing. A lot of new companies will list and probably will have much better direct and larger options to play digitization. Consumer tech as a space is something that we like over the long term. Look, we downgraded it heading into this year. This is something we discussed in a previous interaction as well as now in November, that I'm thinking about shifting to IT services within tech. So we've actually done that. We're more or less neutralish in consumer tech at this juncture. But that's not a bad way to play long term. The only area within consumer tech which is a bit scary for me, and I'm having burned fingers there, essentially is a fintech part of the things where the regulatory clarity is still very tricky at this stage. So that's something that we need to see how that evolves. But that's one way of playing it. IT services will be a beneficiary medium to long term as they are the implementers in any case. But that's a secular growth sort of a sector. I don't really think any of these digitization initiatives are going to lead to a major change in their long-term growth trajectory. It is all about them coming out of this low growth trajectory and moving into the normal trend line average growth over the long term that I guess they should be able to do, which is where there is some value out there.
You know, Venu, just going back to the list that you
Yeah.
were earlier highlighting, I mean, Reliance, Bharti, L&T, it's clearly back to the large caps, right? Does that mean you're like looking at phasing out from the mid and the small caps?
Look, I think mid and small caps are excellent spaces over long term. And a lot of multi-baggers come from there. And I've been fortunate enough to have identified quite a few of them over the last 25 years. But the reality is at this juncture, I have moved to an underweight on SMID relative to large cap. Now, I had this 20% allocation in the India portfolio to SMIDs, which I have actually made it zero right now. It does not mean I would completely avoid every SMID company or every small and mid cap. There will always be bottom-up opportunities that I would be sort of evaluating and investing. So that's the call at this juncture. And in any case, Nifty was expecting, high single-digit return, which is not the case with SMID overall. So that's where I am at this juncture in terms of how I'm assembling. I'm primarily, hence my entire India portfolio is assembled around large caps at this juncture. So look, it's going to change over time. So it's not like something cast in stone. We change it every quarter. We'll see how things pan by and review it a quarter later.
Fair point. But your call to go overweight on IT, and IT, with the exception of Infosys, 2023 was not a bad year for IT. In fact, the IT index did give a return of 24-25%, which was actually higher than the Nifty. So what makes you bullish on IT? Cycle is not great. Valuations are above the historical average.
See, if I were to look at last year, to a large extent, the heavy lifting of returns were done by SMID in IT services. And I was in some way down the line playing it through my SMID allocation. But I was not really directly playing the large cap IT, which to some extent has lagged quite materially last year. The second thing is, within the large cap IT space, the idea simply was that if I'm talking about an IT services earnings momentum bottoming out, you're going to get some negative information even in this particular quarter numbers. But then at the margin, looking at the earnings growth, estimates of consensus that look more or less realistic. Now, the reality, since I'm anyways not negative on the sector long term, I felt that perhaps this is the time to start pushing that sector from a large cap sense. And that's a reason why we decided to have the overweight within IT allocated to IT services. It's not a very large overweight, our largest overweight position in financials. It's a marginal overweight on where the index weights are. And hence, in the India portfolio, we have one large cap, which features out there as the way to play that, because that has been the biggest laggard in any case, trending closer to average valuations historically.
One call which everybody will have to take now, whether it is the election cycle or whether it is valuations or the recent run-up, is that how do you approach government companies? Especially the ones which are dependent on government for orders, railways, defense, infra. How would you approach that space?
Yeah, so I mean, look, there has been this sort of a theme underlying in the market around public sector companies being the ones one should select. And the reasons are very simple. They were relatively cheaper valuations wise, and they were getting their growth. This is across the board. We look at financial sector PSUs to the capex side of things. See, one of the key underlying factors, especially since you mentioned about the capital expenditure linked ones, be it defense or infrastructure, they had this major advantage over the last 2 to 3 years because we were going through a pretty strong government capex cycle. So if you were to look at government's allocation to capex within the central sector budgets and the special allocations they did to the state, they had the flexibility of doing that for two reasons. One, we managed to get a much larger tax collection than expected, especially on indirect taxes. That tax buoyancy basically helped. Number two, we had the flexibility of keeping higher fiscal deficits. I mean, look, if you think about it, that 6-ish% fiscal deficit, 5.86 accounting adjustments wise, it's actually more than 6. This financial year, which is getting over, I don't think we would have been allowed to have such higher fiscal deficit in the pre-COVID era. Right? The fact that we managed to keep them plus 3.5% for states, this is a unique situation. Now, over a period of time, we will bring that down because it could. You have to, of course, align it with how things happen globally, especially risks around inflation and things like that. It's not a perpetual fiscal deficit number. So as you bring it down, your government capex will also sort of moderate and shift towards private capex. So what you're playing right now from a sense of PSU infrastructure is good. I mean, it's still good for a while, especially for the next maybe 12 months. But you will have to start looking at more proactively potential opportunities in private sector. and whether these PSUs can actually tap that or not. Quite a few of them cannot. So that's the way I would. This is a transition phase right now for them, because a mix of capex will change over time.
Venu, great to have you on the show. Thanks for taking the time out. Always good to listen into your thoughts on the markets.
Thanks.
Okay, that's the word coming in from the House of Bernstein. Let's just revisit what the market has settled in at. Actually, nothing at an index level. Of course, there are a lot of individual movers. The entire OMC pack is looking extremely robust. So HPCL, IOC, BPCL, they're all big movers, about almost 2% to about a 2.5% uptick is what you're seeing on the futures. The Shriram Finance is well higher by about 2.25%, and then United Spirits too, which is perked up about 2% or so. But the one stock wherein all the activity in the market interest has been on the slew of order wins that they've had off late has been Suzlon. So let me welcome on board Himanshu Modi, the CFO at the Suzlon Group, joining in on the show right now. Himanshu, hi, morning. Welcome to ET Now. Thanks for taking the time out and joining in today.
Morning. Thank you for having me.
Right. Himanshu, let's start off firstly with the slew of orders that you've been bagging. What's the total order book like, and the book to bill standing at?
So currently we are at about 2 gigawatts, close to 2 gigawatts in our order book, and these orders have to be executed over the next few quarters. So yeah, I mean, we've been, of course, taking advantage of good tailwinds that we've seen in the industry, both in the IPP segment, CNI segment. So we are, as Suzlon, well placed to capitalize on the market opportunity.
Tell me, what's the order inflow pipeline like, and what more orders do you think you're going to bag, say, in the next 6 to 12 months? Anywhere where you're actively bidding?
So, of course, several discussions that we're actively having. Again, very difficult for me to give you a number as to where we land up at in the next 6 to 8 months. But from a capacity perspective, of course, as Suzlon, we can do anywhere between 3 to 4 gigawatts of turbine manufacturing in a year. So with a lot of active orders in under negotiation and discussion, we'll of course come reports the same to the public once we've signed definitive agreements on the same.
Sure. Are more orders now coming in from corporates for captive use, etc., or government orders continue to contribute more?
So it's a fair mix. I mean, some of the recent ones we've seen is largely the CNI or the captive segment, but also there has been bidding activity at the government level. So it's a fair mix of both, I would say.
Also, Himanshu, tell me, what's the average timeline of completion of the projects that you've bagged, and what kind of revenue growth do you envisage for, say, FY25 to 26?
So timeline, of course, depends on the size of the order. I mean, we have very small retail orders as well, and we have big ticket orders as well, which go into multiple 100 megawatts. But safe to say that, a mid to large scale size project would be anywhere between around, I would say, 18 to 24 months, from definitive contract to final execution of the last turbine. That's a fair estimation. On your question about FY25 and FY26, as I said, I mean, our existing order book is close to about 2 gigawatts. A fair bit of that is for FY25, and some of it will spill over into FY26. So again, difficult for me to give a firm number for both the financial years, but certainly it's a good mix of both financial years in the current order book.
Himanshu, morning. Now, there seems to be a worry of lack of EPC players to erect the towers that you make. A few years ago as well, that we had seen that the orders were ready, but the customers had stopped taking delivery. Do you think the cycle is likely to repeat?
So, certainly, I mean, there are challenges for execution on ground, whether it is land availability, power evacuation, crane availability. But having said that, I think, the entire industry as a whole, the entire ecosystem is sort of ramping up to meet the ambitious targets that are set by the government of India. And I think whilst there are on-ground challenges, but there are several EPC companies coming up. We do project execution ourselves, and whilst there would be challenges, but I think we are ironing out over a period of time.
Right. I have to ask you this, Himanshu. We typically don't ask this to managements, but I'm just curious to hear it from you. In the last 1 year, your stock has doubled, or rather has become 4x from 10 rupees to now 40 rupees. Do you think the growth prospects are fairly valued in the stock price, or do you think there's still some gap there?
So it's a very, very subjective question. I mean, again, it's something that as management we don't have any control over. It is the market forces clearly that determine this. From our perspective, I think over the last few quarters, we've done all the right things. Our primary objective was to, straighten up the balance sheet and make that debt free. So I think, with the QIP successfully getting concluded in August of last year, we were able to achieve that. Our working capital tie-ups need to be sorted, the LC and bank guarantee limit, so that we have the ability to execute these orders. That is now behind us. So from a management perspective, I think we've made all the right moves and in a timely manner that we could, which probably is getting reflected in the stock price. So far as valuations are concerned, market dynamics, I mean, those are completely external factors beyond our control that determine the same.
Okay, just wanted to understand from you as well what the working capital days are currently, and depending on the order, what's the overall balance sheet situation?
So working capital days is a mixed bag between our manufacturing and the services business. Having said that, there is clearly room for efficiency on our balance sheet to improve the working capital days. I think once we reach a level of maturity over the next few quarters, we are actually very actively focused on optimizing our working capital cycle. And I think, the street would see a difference on the working capital numbers over the next 2 to 3 quarters.
All right, and what's the outlook in terms of the budget this time around? Is the sector expected to see any big bang announcements, or is there any major wish list from the budget?
So again, I mean, there have been a slew of policy initiatives that the government of India has announced to promote the renewable energy sector over the last year or so. And, we just hope, whatever budgetary announcements we are actually confident will be in line with supporting the growth of this industry. I mean, there is an ambitious target of, close to 500 gigawatts coming from renewable energy set by 2030, and about 100 gigawatts of that has to be from wind. So I'm sure the policymakers and the powers to be will make all the right moves towards ensuring that we meet those targets.
All right, good to have you on board. Thank you for giving us a little bit more clarity in terms of how the business is shaping up. So that's the word coming in from the Suzlon group. CFO saying that execution has been strong for orders. They are looking at a 3 to 4 gigawatt turbine manufacturing a year and are well placed to capitalize on the market opportunities. A quick check-in as to what the rest of the market is up to, and circling around the 21,680 mark for now. It's a quiet day of trade. When it comes to the broader end of the universe, actually we're seeing a cut of about 0.5% or so. So names like Godrej Consumer, Spark, Marico, Bank of Baroda, a lot of the companies that had come out with the Q3 updates or projections are under pressure. AB Fashion feeling the heat, Adani Total Gas, JM Financial too. Those are some of the stocks in the red, while on the flip side, Godrej Industries, HPCL, BEML, Narayan Radale, as well as KC International, they're holding out in the session. Well, lots more to talk about then when it comes to J&K Bank, their Q3 business updates, what the outlook is on their fundraise. And we've got Baldev Prakash, who's the MD and CEO, joining in. Good to have you on board. Thank you so much for taking time out and joining in. I just want to understand what the outlook is when it comes to your overall advances growth in terms of any sort of projections or any particular space that you have seen a little bit of weak growth when it comes to your advances?
Yes. Yeah, good morning. So as far as advances growth is concerned, our guidance was around 15 to 17%, and we are confident to maintain the guidance. And this quarter also, on the net advances basis, it should be 15 plus.
All right. So, what about the pockets in which you can grow? Can you highlight that for us a little bit more about what are going to be some of the pockets when it comes to your advances that are likely to shape up well from here on?
Yes. So the retail growth is coming from our home territory, that is Jammu, Kashmir and Ladakh. And in the retail also, the home loan segment is picking up. We are clocking a growth of over 20% in home loan. And the corporate growth, of course, is coming from the rest of the country segments, basically all the good corporates. That is the strategy we followed last year, and we continue with that strategy.
Okay, fair enough. Wanted to also get in your outlook then on the deposit growth. Are you seeing any challenges then when it comes to, the retail term deposits? Recently, we've had a lot of players like SBI, for instance, increasing their term deposit rates. Is this a trend that you're expecting for the bank as well?
Yes, so as far as the growth in retail deposits is concerned, we don't find much challenge. Our CASA has been maintained over 50% and on a consistent basis, it has been above 50%. Yes, cost of deposit will be a little higher, little elevated. I think maybe another 6 months or so, it should remain a little elevated and then finally settle down.
Right. Mr. Prakash, what about your asset quality? How do you assess it so far? And do you think there's stress building up, specifically when the regulator is also showing concern and being cautious?
Yes, Aisha, assets quality has been the biggest success story of the bank. If you see the numbers in the last 2 years, 1.5 years, you'll see consistently quarter on quarter basis, we have not only achieved our guidance, but rather surpassed that. As of today, I'm talking, we are already below 5%, and our guidance is 4.5% on gross NPA. We are very confident that we will be meeting our guidance of gross NPA, and our net NPA is already below 1%. So we don't find any stress building up because the selection of borrowers from the angle of the quality of advances has been top class for us.
Also, we've seen some amount of uptick in the cost of deposits for most of the banks actually, and NIMs as well have been stabilizing a bit if you were to look at the Q2 numbers or how the Q3 updates have been. What's the situation at your bank, and how is it that you're placing yourself to absorb the cost of any of the deposits?
Yes, so CASA remains the strength for the bank, but of course, as far as term deposit is concerned, we have to align our deposits rates with the competition. So from that point of view, little bit elevated cost of deposits is expected, and it should remain in this territory maybe another 6 months or so. But that is not a cause of concern for us because we are maintaining our NIM in the guidance which we have given in the beginning of the year.
Much of your current business is only coming from J&K. While this is an advantage, but this also means that beyond a point you will struggle with your growth.
Yes, Nikunj, J&K story is just opening up. And the type of activities which we are seeing in Jammu and Kashmir, of course, led by the tourism, inflow of the tourism, we are quite hopeful that the growth will be led by J&K, and the type of strength the bank is having in Jammu and Kashmir. I'm very confident that we will be the first choice as far as bank is concerned for the customers. And as far as our rest of India operations are concerned, we are there for the last 1.5 years. We are quite an active player as far as corporate banking is concerned, and we will continue to maintain our dominant positions. And this year, we will be supporting our rest of the country operations with the good home loan growth also.
Specific in terms of the split then, let's say how much of the total business, future business in FY25 will come from J&K and non-J&K?
So as of now, we are maintaining around 67-68% from J&K, and the rest of the around 33% from the rest of the country. This business mix we are likely to maintain in the coming years also.
You had an advantage because no large banks essentially came to J&K for historical factors. I'm not getting into why, but that was an advantage. Now competition is owning. UPI has kicked in. Transfers are easy. Internet connectivity is great. Could your J&K business come under threat because of new banks coming there?
Let me reply it in two parts. As far as deposit is concerned, yes, likely to have some competition, particularly in the term loan segment. term deposit segment. And yes, because of that, our cost of deposits may be little elevated. But as far as the loans are concerned, I'm very confident the type of support system we are having on the ground and the connect of our people with the local population. We don't find much challenge as far as the loan growth is concerned in Jammu and Kashmir.
What is the updates in terms of the utilization or progress of the 750 crores via QIP? Are you looking to expand in other regions? What kind of investment will this yield?
So this is the purely the growth capital, and I'm very happy to tell you that the type of response we got in the QIP is phenomenal. It's unprecedented. So this entire money we will be utilizing for our growth, and that will be led by the retail in our home territory and corporate in the rest of the country.
Okay, and what about the outlook then? The wage rate hike that came out at about 17%. How is the bank placed for wage rate hikes?
So we are expecting absolutely soft landing there. So we were maintaining a provision of around 15%. So little bit, it is in the range of 15% or 17%. So we don't find much challenge there because already the substantial amount has been provided for.
Ankur karega. Okay. Could you give us any bank has three models. One, you get money because of transaction, which UPI has taken over. Second is fee-based income. And third is money which you will get largely because of lending to corporates and term loans and home loans. How are you likely to grow your fee-based income?
So this is a good question, Nikunj, and I would like to tell you that as far as the UPI transactions are concerned, would request you to come and see the market in Srinagar. You will find that UPI, the Jammu and Kashmir Bank UPI, you will see in the lot of small vendors also and the shops also. And we are quite hopeful that we will continue maintaining our dominance in the UPI segment. As far as the payments is concerned, yes, some competition will be there, but we are quite prepared for that. As far as the other fee income is concerned, our strategic move to shift treasury operations from Srinagar to Mumbai is now paying the dividends. We have already engaged one of the big fours for consultancy as far as our income from treasury in all the products is concerned, and that should be seen in a few months now. And we are confident that the treasury of the bank will also be another profit center.
Right. The other thing I also wanted to ask, Baldev, was how is it that you're utilizing that 750 crore rupees that you raised via QIP? What's the progression like?
So this will be mainly in the growth in the corporate as well as the retail segments, and the type of growth which we are seeing in our home territory, we were in the need of this capital. I think it has come on the right time. And going forward, we are expecting our rating to go up, and then the amount in case we require in future, we will be raising through bonds and which will come at a cheaper rate to us.
Appreciate your time. Thank you for joining in and giving us a bit more clarity on J&K Bank and the numbers ahead. All right, meantime, let's hear it out then from some of the top voices, market voices that we've been interacting with, the likes of Ravi Dharmshi as well as Rajat Rajgharia, talking about some of the key themes and sectors that they're betting on.
Couple of the leader banks not giving any kind of a return creates the perfect base for to start thinking of placing bets in terms of from 3 to 5 years perspective. So I am again, without naming anyone, the cycle in financials remains in favor. Large lending, the private banks remains favorable. The capex cycle is just beginning, the private capex cycle. The corporate lending growth will pick up going forward.
I think the second area which we've been talking about is, as I said, if you can put it all in the bucket of manufacturing or cap goods, infra. I mean, that whole pack, power, real estate, renewable energy. I think you find companies, quality companies there, and I think you could compound at 20, 25, 30% a year for the next couple of years, right?
EMS as a space, whether it is +1 or not, is going to boom anyway because the electronic component in our daily lives is significantly going up. Now, having said that, these stocks have rallied a lot. So it is not as if they have not rallied. Their earnings will also grow, may not be structural, may not be like every quarter it grows. So you will see surprises here. Those are the opportunities to buy.
We have been at the beginning of this year, 2023, right? I would think that PSUs generally as a theme were starting to, make some buzz. You had defense, you had budget, you had government speeches, you had many indications of railway capex, defense budgets, EMS, renewables coming up, right? So you could have tried to take a stock, buy, sell 4 times in its journey of being 3x, right? If you would have bought a stock at the beginning of that conviction and rode through that entire rally, which is still not over, which is still going to continue for the next few years, right? You could have possibly captured the entire 3x, 5x, right? If you do buy, sell because sometime valuation looks high, then the story becomes better. I would think you would capture less than half of the return that your conviction would have delivered it to you. I think the same thing holds true for suppose state-owned banks, right? How many times we have seen 0.5 pe kharido or 1 time pe bech do, right? I don't think we have seen balance sheets and growth orbit better than this in the last 20 years of these banks. So why should they be constrained by a historical valuation band? Why can't they trade at 1.5, 2 times if they can deliver 16, 17% ROE for the next 3-4 years? Which means that we are still talking about these stocks that can potentially double from here after doubling last year, right? So I don't think they are anywhere close to a bubble now. I don't think if they rally another 50% this calendar year, they would still be in the bubble. Just that the stories are getting better as the growth orbit becomes better.
But within PSBs, because it is a large enough pool, how do you select? Do you stick by with the leader or do you buy a basket of some?
Look, best of them, State Bank definitely leads from the front, right? And I think that the next two you can always bet upon, right? I think this market has so many different categories of investors that the options to pick stocks within PSBs or any other sector is also relevant to the style of the investor who is looking at the names, right? Someone willing to put in $1 billion State Bank is the obvious choice. Someone willing to put 100 crore, you have another second tier, third tier. I won't say second tier, third tier, but the smaller size, right? For retail investors, you can see that the volumes in some of the even smallish PSU banks are, because ultimately all of them are benefiting from the same story. Someone is delivering better than the other. Somewhere the valuation is cheaper than the other. So your core portfolio should have the best, the largest,
of course,
right? But the market is a combination of all kind of stocks. So I think as a theme, if you like something, you can keep trading in between some and hold core as some.
Sure. So defense, there's PSBs, what else? Where is it that you find there's still value on the table?
I think as a theme, Aisha, we have been very positive on this whole travel and tourism as a space, right? This is again a sector which is just coming up in this country after COVID, right? I would say the last 18 months was the period when this sector started showing its way of leadership on the consumption side. You look at hotels, you look at aviation, you look at travel accessories, right? As the per capita consumption, travel, office travel, leisure travel, entertainment grows, right? There is a huge business opportunity for them. The other thing is, because of the COVID, the capacities have been constrained. If you guys would have traveled anywhere in this whole holiday period, I don't think, just look at
the crowds.
Just look at today hosting an event in India is expensive than hosting an event
outside India,
right? And still you don't get vacancies, right? I think this is a theme here to stay. One is the earnings growth, and second is when these companies generate a lot of cash flow, the balance sheet becomes very solid. From a debt-ridden balance sheet, these companies are going to become cash-rich balance sheets. So ride through this cycle, and I think over the next 2 years, you are going to see many new listings, many new opportunities in this travel and tourism. That is how big sectors typically get developed, right? Today you have 4 or 5 hotels listed. I think in the next 2 years, you may have dozen IPOs of the hotel companies coming up, right? So I think this is one theme besides financials, besides consumption, select consumption, besides industrials. But I think this travel tourism looks like a very powerful theme in the making for us.
And what's driving the optimism in consumption, even select consumption that you're talking about? Are not the worries of inflation, rural slowdown likely to be deterrents?
So I think the consumption basket is essentially driven by what is it that you were not spending on, which you are spending now because of the income level increase, right? What you have been consuming on a regular basis, right? You may not increase your wallet share there, but what you have not been consuming, and because of the general, like for example, where do you classify real estate, right? If you look at the amount of real estate optimism that has come in the last 2 years, it is the wealth impact which is happening partly because of the economic growth and partly because of the stock market wealth creation, right? That I categorize as some form of consumption, because this time you are seeing first time house buyers or people expanding into larger houses for self-consumption, not necessarily for investment. Secondly, if you look at, like again, I'm coming back to this travel tourism, right? Why are people traveling more, right? Why are people spending more? It is because because they can, right? And because they want to also, right? One is affordability and second is intent. Now both are being met, right? So I think you keep figuring pockets of, consumptions which are going to come up. May not be the traditional FMCG, right? But maybe many items. And I think the last thing is the whole IPO market, the primary market. If you look at the number of IPOs that have come in the last 3 years, I would say roughly about 50% plus would have been linked somewhere to consumption. So this whole options being available to invest also is drawing up a lot of money into these sectors.
If you have to, let's say, make a probability, where the probability of beating the Nifty, which is 15 to 16% according to you, is high, which are the three stocks which could be the standout names for 2024?
So just within the Nifty, I would think you can make one pick between an SBI or an ICICI. Because for any stock to deliver a big return,
SBI
the starting
and ICICI,
valuation...
I didn't hear HDFC Bank.
So, then I would have to narrate all the banks listed in the Nifty, right? Okay. So I'm just picking the top two within our universe, right? I think second is M&M as a company looks pretty good for us. If you look
even
at
these levels, because it's had a phenomenal run since COVID.
So when you look at the entire sum of the parts story, you may have a scenario where all the pieces are now beginning to look good for them for the next 2 years, right? So I would think that M&M is again another thing which can look pretty good. I would think that if we are so positive on industrials and capex, then the one allocation stock in this country is just L&T, right? And that will continue to compound because the size of the opportunity they will target every year will keep growing high. So I think these three, at least right now.
And you said select consumption, so anything there?
So in the consumption, I can give you basket. You can look at QSR, you can look at jewelry, you can look at travel and tourism, right? You can pick up stocks that our analysts portray. But I think these three, and I can tell you there are more spaces which are going to come up in the consumption basket is going to be bigger than the financial basket, when you will club all of them put together in the next 18-24 months, right? Just a year back, Titan used to be one jewelry company that used to be spoken about. I think in another 12 to 18 months, you will have dozen of jewelry companies being listed. So Titan would still remain
the leader,
but you will have many other alternatives to invest in, right? So this market is going to offer a lot more opportunities, and that's why we say broader market will keep offering you more opportunities, while in the index you have to be selective.
Okay, let's move on and let's talk further as to how the state of the markets as well as the economy is going to shape up in the year ahead. And we have with us Sayan Mukherjee joining in on the show right now to discuss exactly that. Sayan, hi, great to have you on the show. Thank you so much for taking the time out, and Happy New Year firstly from all of us here.
Yeah, thank you for having me, and Happy New Year to you as well.
Sayan, paint the big picture for us. What are we staring at in 2024 after what's been a phenomenal fag end of the past year?
Yeah. So I think clearly the India's micro and macro is looking quite okay at this point. I think the key variable that we are sort of linked to is how the global macro settles going forward. So particularly towards the later half of 2023, I think the narrative significantly changed. Even we as a house at the start of 2023 were very cautious, looking at a deep recession sometime in 2023 in the US, but the growth has remained quite resilient. And our views have also changed. And we are now looking at sort of a mild recession. So you can say we are kind of talking about slightly cautious compared to where the street expectation is, which is probably a complete soft landing. So I think we are sort of dependent on how the US or the global economy shapes up. So to that extent, I think we may see volatility in the stock, particularly after very strong rally of around 20% that we have seen last year. But having said that, as we look forward, in the medium term, I think both economic growth rates and earnings growth rate, I think should be quite resilient. In fact, we are talking about, anywhere in the range of 12 to 17% earnings growth in the medium term for India is very much possible. So we are constructive in that sense, and therefore, would be sort of engaging, buying more as and when we get opportunities in the market, which can happen this year. We can see volatility, given that most of the expectation on macro currently is on a higher side.
Aside of that, also, Sayan, there'll be two big events, right? In the first half, there'll be our own elections, and in the second half, the US elections as well. You think the markets, and not just for us, but across the globe as well, would be hugely volatile around these events? And I ask because, there's a precedent of the state elections and the way we shot up after that.
Into elections in India, assuming that we will have a continuity of the government and policies, I think that's the base case that we'll work with. In general, I think from a global perspective, given the deficit levels across most markets are quite elevated. In an election year, the governments tend to spend a lot more. So in that sense, there are macro risks that can come through, particularly if, let's say, inflation remains quite sticky and the yield starts to move higher. So that's one risk, that one has to sort of deal with in 2024, given a very, a very busy, election calendar.
Right, and you did touch upon earnings growth. I just wanted to understand, in light of this, the fact that it's an election year, there is going to potentially be that pickup in private capex and exports. What is the outlook as to which are the individual sectors that could be potential beneficiaries of this?
Yeah, so when we think about the earnings, so when you talk about the earnings in the short term, right? I mean, if you look at just the next couple of years, at least in the benchmark indices, I think financials are the big contributor to earnings, over the next couple of years. And given the balance sheet size, we don't have many credit cost issues as such to talk about, even in case, let's suppose we see somewhat of a slower growth than what the base case is. So I think when I look at the next couple of years, I think financials as a space would be the important driver, and that's where we have a fair amount of visibility. Now, if you look at from a slightly medium term perspective, I think the key for India, and that is what I think the policy is all sort of geared up to, is to support local manufacturing. So what we are expecting is pick up in local manufacturing and that should also be sort of lead to improvement in private capex, which has been a bit subdued for a very long time. We are seeing some signs of a pickup, but it has been subdued for a fairly long time. But going forward, as we see traction in manufacturing, our expectation is that we will also see a very strong pickup in private capex. So manufacturing, private capex, exports, these would be the drivers of corporate earnings over the medium term. Of course, this would have a rub-off effect on consumption as well as we go forward.
Okay, fair enough. Let's also get in a sense then as to what the outlook is in terms of the inflationary factors really working itself into mass consumption. I believe that your report's talking about how the slowdown will bottom out with low inflation and interest rates, but is there any sort of worry or a concern when it comes to inflationary pressures for consumption as a pack?
Yeah, so I think there are some near-term risks, particularly on food prices, for instance. So there can be those volatility, but structurally, I think the inflation is headed lower. And let's say if our call, right? So if you look at our call globally, we are talking about slower growth across most of the economies versus where the street is. We are not that bullish on China either. So I think, and I'm expecting that the inflationary pressures would not be a problem in this year. And to that extent, it should help mass consumption. Mass consumption has been sort of struggling, especially if you look at the rural real income. Has been quite weak since the pandemic, and I think as the inflationary pressures ease, that part of the economy which has been struggling may see some signs of bottoming out and gaining some traction.
Okay, fair enough. That's the view coming in when it comes to the entire consumption sector as a whole. And just wanted to get in your outlook as well in terms of the policy thrust when it comes to private capex, when it comes to manufacturing, infrastructure, investment as a whole. Do you think that expectations are riding high, that a lot could emerge from this budget or even just down the line for the year ahead in terms of announcements for these individual sectors?
No, I think there is definitely, there is definitely, we are seeing policy thrust, which is sort of factored into the prices to some extent, I would say. So therefore, one has to really pick and choose there. As a theme, we are very constructive because, as I was mentioning to you earlier, that today manufacturing, right, as a percentage of GDP is just around mid-teens at decades low actually. And the government intends to take this up to almost 20% plus. Now, this is probably not going to happen in a very short period of time. But then, incrementally, we will see manufacturing as a percentage going higher. And as I was mentioning to you earlier, that if you see the ratio of manufacturing to gross capital formation by the industry, that's almost at historical peak. So the moment we see manufacturing, picking up, it would lead to, the private capex actually, growing at a faster clip. So that is what we think, would happen eventually. But I must admit that. Many of these themes and stocks have already rallied quite hard in the last year or so. And hence, to that extent, I think one needs to be selective. But as a theme, I think if you get an opportunity, as and when you see correction in some of these stocks, I think this makes a very good investment case from a medium term perspective.
In continuation to that, besides the overweights, what are the underweights that you have in the current market?
Yeah, so I think on as far as the sectors where we are underweight currently, I would say, as I mentioned, right, in industrials, the valuation looks pretty stretched. So if you look at industrials, defense, these are some of the names where we appreciate the medium term story. But I think we would sort of wait for the right price point to sort of get in there. Similarly, we find consumer discretionary. Again, that is something which holds long-term prospects. We are relatively sort of cautious given the run-up in the stocks that we have seen. There has been very strong affluent spending or pent-up spending which has happened. I think that should start to slow down. And therefore, given one can be relatively more cautious. And finally, on IT services, again, we are still cautious on that, and we think that we would see probably we are not seeing any major pickup in discretionary spending for that matter. And if we see a slower growth in the US, we will continue to see earnings getting cut, and therefore that's another space we would be relatively cautious on.
Simon, the big theme that worked very well all through last year was PSUs, right? And I'm talking ex-banks here. Any public sector undertaking sector, pick up any stock or a basket of those or a bunch of those, and it all did well. What do you think would be the theme for 2024? Or would we have to be more stock specific than that?
Yeah, I would say so, because if you look at public sector, I mean, there are pockets which have rallied very hard, and somewhere, we feel a bit discomfortable, not so comfortable with the valuation, whether you look at defense or whether you look at even some of the power equipment manufacturers. But, then there are utility companies which are still sort of appears to us quite reasonable. There are banks which are very reasonably priced. So to that extent, I think I would not like to sort of, have a view across all the PSUs, so to say, but I think there are good opportunities, reasonably valued PSUs that one should look at. But yeah, it would be more selective, I would say.
Okay. And just wanted to know for the year ahead, San, if there were to be any, sort of black swan events or any risks or concerns, do you believe that largely that will emanate from overseas, or are there any niggling worries or concerns domestically as well?
No, I would say that it's mostly overseas. Of course, as far as domestic, we have the elections, which we have to negotiate. But internationally, I think the base case is a soft landing at this point. And in case we get no landing or a hard landing, I think we may see in both cases, markets heading lower. Now, as a base case, I mean, we actually prefer, to see probably a hard landing than no landing, because at least, a recession or a slowdown in the US would be a clearing event for the market, and we can, think more clearly years ahead. And that could be an event which could also set the stage for the recovery in, private capex that we have been talking about, for instance. On the other hand, you can also have a no landing scenario where, sort of we kind of continue to see higher inflation and yields go higher, and the market continues to sort of expect a recession down the line, and that's not good for the market. I mean, we would probably see lower valuation multiple in that case. So I think the risks are mostly global. The macro globally hasn't yet settled. There are positive expectations and we are close to it, but we have to keep sort of watching and be nimble, because those assumptions can change in due course.
Simon, the other thing that I wanted to talk about, what's happening in the IPO market. Of course, 2021 to 2022 was a lot different. All these big names with exuberant valuations came about, and then there was that funding winter. But 23, we've seen some smaller IPOs also see huge amount of subscription. And some phenomenal gains have been made within the IPO market. Is that telling you a bubble in the making, or would you already get a little cautious here?
Yeah, I mean, it does indicate that overall there is a positive view, right? I think, we haven't seen any major sort of crash or an event in the market, so to say, since the COVID pandemic started, right? So I think the liquidity environment has been extremely supportive, which actually has led to this kind of optimism. And again, as I said, if we get a soft landing and we don't have a major accident, as so to say, probably we will continue to see this level of exuberance continue in 2024. But then again, that's the sort of bullish view or an argument. But then in case we see a hard landing or again a flare up in interest rates, we will probably see these enthusiasm come down.
You know, just taking that point forward, given that India is home to the third largest startup ecosystem in the world, give us a sense as to how you're looking at this space as a whole, you know, with digitization as well picking up, new age technology growing quite fast. Do you think that worries about the startup funding winter are now behind us?
See, I think, of course, things can get tighter, and we have seen a phase where, things are tougher. You have seen, a lot more funding difficulties in many of the startups. It's probably not as easy as it was just after COVID. I think that trend can potentially continue, but I guess there is a lot of interest in India as an economy, right? And I think if there are businesses which have proven themselves, I think would be able to attract funding. So funding would be more selective, I would say, but nonetheless, I think the interest that we have in India today is quite high. I mean, India is doing much better than many of the other economies. So to that extent, I would expect good businesses where the business model is established would continue to sort of get adequate funding.
Okay, appreciate your time. Thank you for joining in and giving us an all-round view as to the macros, the earnings, as well as the outlook when it comes to individual sectors and the startup ecosystem. Tell you what, we'll slip into a quick break with news that the index is at 21,696. And names like UPL, Tata Consumer, ITC and HUL are under pressure. Be right back.